Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Patrick Horan, principal at Agilith Capital, will be joining us for the hour, and we want to hear from you this morning on First Call. Reach out with your questions, and we'll have Patrick answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We will open the phone lines in about 30 minutes. You can also email us, and the address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Stellantis is exploring plans to build electric vehicles in Canada with Chinese partner Leapmotor in what could become the first major Chinese auto investment since Ottawa eased tariffs earlier this year. Discussions are focusing on the idled Brampton, Ontario plant that Stellantis has, though talks remain early. Bloomberg News first reported the plan, which was later confirmed by Unifor. Finance Minister François-Philippe Champagne has been joined by Bank of Canada Governor Tiff Macklem and Bay Street executives in China. The Canadian delegation is meeting with Chinese officials to build on the diplomatic reset that occurred earlier this year. The group includes the chief executives of Manulife and Sun Life and the vice chair of BMO Wealth. Talks are expected to include opportunities in financial services and healthcare. And now our top line story. Stocks and bonds fell as oil surged, with U.S. President Donald Trump dashing optimism that the war in the Middle East was nearing a swift resolution and that disruptions to energy flows will ease. For the latest market impacts from the war in the Middle East, let's bring in, you can see the futures right now reacting to that speech last night, not reacting in a happy way. Let's bring in our guest for the hour, Patrick Horan, principal at Agilith Capital. Talk a little bit more about it, get his thoughts on it. First of all, what did you think of that speech?
Well, as usual, it's he kind of sucks and blows at the same time. But he's been back and forth. I don't think he has an end goal in sight, other than to figure out how he looks good at the end. So until he sees that opening, I think we're kind of trapped in this back and forth.
And are we going to see the markets, do you think, reacting that way, continuing to react? I mean, this week has been another crazy week. It's up, down.
Yeah. So
any optimism or any negativity?
So we believe we're over the crest of the worst point, and that there's a pathway for peace here. More importantly, there's a pathway for oil flow. Mm-hmm. We think it's going to take a long time. It's definitely going to involve the Gulf states and other nations, kind of like a make-force UN peacekeeping arrangement. So we think that's the end point, because you're going to have so many parties involved. It's going to take a while. It means oil is going to be higher for longer. And it means probably there's this whole ordeal is probably put in a risk premium in oil that will last for years. Right? We figured $10, $15 a barrel is for a couple of years.
First, what's your reason for optimism that you think we're past the worst of it?
Well, because the market is a discounting machine, and we saw the VIX, the volatility index, go through 30. That's a stress point. When the VIX starts to decrease, the market has priced in the worst. We saw the other thing too is we saw the U.S. dollar really strong, unusually strong, and we thought that was a lot of money on the sidelines. So our sense is the VIX is starting to fall, so people are buying the bottoms here.
Yeah.
Now, you don't want to chase it because you think there's more to come. There probably is more to come. But you can safely buy stocks, especially ones that have been former leaders. And when I say leaders, especially leaders over the past year, not leaders from the past 5 years, but leaders of the past year. You can buy those on the dips, especially ones that have come back down to the 200-day or their 50-day moving average. Those are good entry points.
Do you feel it's coming back to a kind of a new normal over what people might be looking at for stocks? Will this be the break that kind of completely separated us maybe from the Mag 7 and AI, and
Yeah, I do. I think that's a really good way to put it. Yeah, I do. I think this is a turning point. And if people before we had a bit of a jump ball between what is leadership, you've got technology that frankly we thought was exhausted here, but the separation seems to be pretty clear between software and semis. They kind of take their turn getting pummeled, and what we have seen is industrials and commodities and frankly the TSX have a lot of resilience here. 10 years ago, the markets went down. The TXX went down 1.3 to 1.5 times faster than the other markets. People didn't want the cyclical risk. Now the cyclicals are good for you. They're good for the portfolio. So they're buying those cyclicals underneath.
And with the and going back and thinking that oil may stay elevated, and it looks like it might. And how much will Canada benefit from that, or is it going to be kind of neutral because we're going to be paying more for oil or fuel, but we'll sell it for more as well?
No, I think I guess the question is, are you a consumer or are you part of the economic engine? I think if you're part of the economic engine, this is good for Canada. If you're an exporter, there's an argument the Canadian dollar is probably going to go back up here. It's going to
it has ridden along with the U.S. a bit this time.
It has, and that's because of the oil premium that we have in our dollar. But if you're a consumer, you're going to have to get used to paying more at the pump. I think you put it in perspective. The average amount that you have to pay is probably 3 or 4% of your overall expenses. So it's not going to be super demanding. But more importantly for Canada, it does reposition us. It does give us the element of rule of law and safety and providing a backstop in what is a very uncertain world right now. And I think we releverages our point to the U.S. about who we are to them. The quote their oil neutrality is only because of our heavy crude going into their refineries. Otherwise, they'd be stuck here. They'd be stuck like everyone else.
Do you think Canada can take advantage of that, though? That's always the question. It seems to. This is an opportunity for it.
I think it's a huge opportunity, and I think it highlights who we are as a relatively peace-loving country that has all kinds of things to offer, in this world of chaos, we are a pretty stable force, and we are because of a lot of different factors of who we are and what we're about, and the resources.
And where we are with having the U.S. beside us.
That's exactly right. Yeah.
All right, we got to take a break on that note there, but lots more to talk about. Up next, though, we'll take a look at the markets before the bell. You might not like what you see, maybe you will. See how things are shaping up on the markets right now. We'll start with the U.S. futures. And Trump giveth and Trump taketh away. That speech last night not reassuring the markets right now. And you can see the reaction to it. Dow off by 1.5. NASDAQ been volatile like heck this week. It's off by 2.14. And the S&P 500 off by 1.7. Asian markets finishing the day red. The Nikkei up by almost 2.4%. Hang Seng down by 0.7%. And the CSI 300 off by a little over 1%. And the European markets, everybody reacting to the Trump speech last night, not happy with it. Look at the DAX off by 2.3%, with the CAC Caron down by 1.3%, and the FTSE off by 0.4%. TSX yesterday had another good day, closing in on 33,000. They doubt we'll reach it today, though, but who knows? The day is long. Finished the day up just shy of 33,000, up about 0.6%. Some of the winners and losers from yesterday. Discovery Silver up 9.84%. Capstone up nearly 8%. Going the other way, Birchcliff Energy taking a hit. Was the index that was down, off by 11.4%. And Ivanhoe Mines down by 11.6%. Looking at metals now. And just the week that was. Gold off by almost 4% right now. Look at silver. Everybody reacting to that speech. And gold down to still up. It's up at about 4,600, but down for the day by nearly 4%. Silver threatening to drop below 70 again. Copper also down by 2.2%, right around that 5.5 mark. Western Canadian Select yesterday was down. Everybody reacting. The oil was down yesterday and up by 5.9 at 75.40. But today, WTI, what do you think it's doing? Yep, it's up 10%, nearly over 110 a barrel right now. Okay, looking east, the Bank of Canada Governor Tiff Macklem has joined Finance Minister François-Philippe Champagne in China as Canada pushes to galvanize trade between the two countries. For more on the growing trade relationship, it was strained for a long time between China and Canada. We turn to Patrick Horan, principal at Agilith Capital. Patrick, your thoughts on this latest trade trip to China? We're seeing a couple of insurance companies there. Everybody sees some opportunities, don't they?
Yes, they do. Our canola, our grains, and hopefully, oil out via another pipeline. All of those things would be good. I think we spent 40 years basically chumming up to the U.S. Without a check and balance, and China is going to be our check and balance to that relationship. Sorry, it's going to be their check and balance for taking us for granted. And so we desperately need that. We need to basically say, there's a competitive force here that if you don't want it, we'll go elsewhere. And China is really their easy answer to enforcing that leverage point to the U.S.
Well, and I saw today somebody pointed out that U.S. is doing business with China and trying to grow their business with China. So we're not being the bad guys when it comes to CUSMA and everything. Right. So we're seeing opportunities. Right. And I know oil is the big thing for us, yep. But that takes time to get set up and get Absolutely. Going. What shorter term opportunities do you see for Canadian?
Well, hopefully, I think we're going to get to electrification of cars and Chinese cars coming into Canada. Certainly, our financials are there, Manulife and Sun Life. We can do manufacturing deals, both on site and off. So I think there's probably other things that are out there, but the world's a pretty big place, and I also think there's other opportunities with Europe as well. Because the other thing that's glaring in this whole oil crisis is just how they need an alternative other than the Gulf, and there should be, if we can actually get a pipeline over to the east. Again, that would be a wonderful thing.
I hate to use it, but that's been a pipe dream for a long time. Quebec is saying no. We get objections from elsewhere.
Yeah. Well, taking down historical barriers are pain points, but they're necessary, and we just have to. You face two pain points, and you figure out which one's more painful, right?
And deal with that. You mentioned about Stellantis trying to partner up with Chinese companies for building electric vehicles here. Yeah. Doug Ford, the premier, not happy about it. At least the current potential. He wants to see some changes to that. Yeah. Do you think we could see Chinese vehicles being built here?
I hope so. And I think what he was setting up was a goalpost to say, hey, we just don't want to be a backdoor of manufacturing that happens completely in China, and we just become a selling agent here for North America. Yeah. And effectively, it would just be for Canada, and destroy our automotive industry. We both spent some time in Windsor. Yep. We know how important that is. Yep.
Live and die.
So I wouldn't want to see that. But having said that, I think it's undeniable that they're the leaders in electrification, and their battery technology and manufacturing and how lean they are. It's absolutely impressive, and we could learn from that We can unshackle ourselves from this very traditional manufacturing that basically was invented in the 30s through the big three in the States. So we do have a lot to learn here. Change is necessary. It's a component of life. We have to step forward. Now, I understand Ford's point. Let's not destroy and put ourselves in peril, but let's do this incrementally, and let's see what can possibly come out of this. So I see this as job creation what we have to understand is that a battery driving a car takes a lot less labor to put in. There's more costs involved, but there's more capital investment up front, more robotics, but ultimately that is what we're going to have to all face. So let's get on it. Let's move towards that end post.
All right, we're going to take a break right now, but we'll be back with Patrick Horan, principal at Agilith Capital, to see why Atkins Realis is on his radar. Time to see what's on the radar for Patrick Horan, principal at Agilith Capital, and we're talking nuclear power, renewables as well. We've been talking oil, so let's go the extreme other way.
Yeah. So this oil is highlighting the issues that a lot of countries have because they subsidize oil. They especially when they don't have a lot of oil, they try to keep the price of gasoline and fuel stable, so they subsidize it. So their budgets are just exploding right now. India, Korea, Southeast Asia.
You're reading horror stories actually in Bangladesh. There's people, they're robbing companies and killing people trying to get oil. They're so short right now.
Yeah. So you just look at, okay, what's the solution here? Well, they can have some form of energy independence with nuclear. We think that is the logical answer. We're talking about this offset for a second on terms of just where we're at with the pendulum. But the pendulum hit a low point with Fukushima, where Germany was canceling all of their nuclear plants. I think all but like 3 plants in Japan went offline, but nuclear plants. And we're starting to see that pendulum come back, where nuclear is a friendly word again. It's an open word. We are going to see a lot of countries relieve themselves of the issues, the volatility, and the costs of petroleum with nuclear. I mean, so that's our view.
The reality, it's good at what it does, isn't it?
Yeah, it is. It is. It's a great technology. It is very safe. We've had our disasters, but when you actually look into it, how many people died in Fukushima? Not one person died. They can't even really trace people who have cancer from that incident. They're strengthening their safety protocols. So we look at it and go, this is the logical answer. This is where, and it takes a long time to build these plants.
Well, that's the thing. But Atkins Realis, CANDO. I mean, I remember growing up in the 70s, everybody talked about CANDO because it was so cutting edge.
Yeah.
Are they still there as cutting edge?
They certainly are. They're the only ones that don't require heavy water. They have a different technology. Atkins owns the CANDO proprietary technology, and we're using it here in Canada and upgrading plants. Romania. There's other India. There's other areas that they're using this technology. We look at it and go, okay, this is going to be an answer. So when we haven't really seen this. Atkins has been more what we've seen as a correlation to data center stuff, which is definitely a big user of energy.
Modular. Everybody's talking about the modular.
But now we should see Atkins be more pro oil. So when you see oil stocks go up, Atkins should benefit from that, and that's what we're expecting. So we see their future in nuclear as a very, very long runway here.
And do you think they can meet demand?
I think they can. I think they can because a lot of it is their engineering, their know-how, and in terms of the construction, they'll bring other people in, and they'll be partnered up with countries to locally employ and develop the actual plants.
And what else in this sector are you looking at?
In terms of nuclear,
Yeah, or renewables.
Renewables. That really is our big idea in terms of renewables. We don't really see, wind and solar have their niche opportunities. Solar is really good for deserts and places that have sunshine 95% of the year. But in terms of Canada, we have some selected wind areas. But really, if you want to power a city, and you don't want to go across 5,000 kilometers, a nuclear plant's your best option.
It also needs water, though, right? And you need a water source.
You do need a water source, yeah.
Yeah. So were any worries about that limiting where they can go?
No, I don't think so. You can. There's different ways of putting in your own massive pond systems but there are some considerations when it comes to that. It's a good point.
Okay, we're going to take a break there, but still ahead, Elon Musk's rocket company SpaceX has reportedly filed to go public. We have more on that after the break, and our phone lines will open soon for our first call segment. Reach out at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. Oil prices are surging. Markets are dropping after U.S. President Trump said strikes in Iran will continue. In a primetime address delivered last night, Trump said U.S. forces have significantly weakened Iran, calling the military campaign unstoppable. However, Trump added, operations will continue until objectives are fully achieved. The U.S. president also threatened to strike Iran's electric generating plants if a deal isn't reached. Stellantis is exploring plans to build electric vehicles in Canada with Chinese partner Leapmotor in what could become the first major Chinese auto investment since Ottawa eased tariffs earlier this year. Discussions are focused on Stellantis' idled Brampton, Ontario plant, though talks remain early. Bloomberg News first reported the plan, which was later confirmed by Unifor. Finance Minister François-Philippe Champagne has been joined by Bank of Canada Governor Tiff Macklem and Bay Street executives in China. The Canadian delegation is meeting with Chinese officials to build on the diplomatic reset that occurred earlier this year. The group includes the chief executives of Manulife and Sun Life and the vice chair of BMO Wealth. The talks are expected to include opportunities in financial services and healthcare. Taking a look at the U.S. futures quickly, responding to that speech by Trump, not happy with it. Dow off by 1.37, NASDAQ by nearly 2, giving back a lot of the gains, and the S&P 500 off by 1.5. Major tech company SpaceX has been rumored to go public for years, and the wait may finally be nearing an end. Reports suggest the company has made a confidential filing toward a potential IPO. To break down what this could mean for investors, we sat down with Jeff Parks, CEO and director of Stack Capital.
When you look at this, you have three segments in this business. We have the launch capability, we have the Starlink side, and then we have obviously Mars and XAI as well in the business. So there's a lot of levers for growth. There's been a lot of CapEx built up in this business, which allows it to have a lot of high margin free cash flow and growth going into the future. So I think they can substantiate this underlying valuation, and we think it can trade quite well in the public market.
Where do you see the biggest growth for them? I know they have a number of government contracts, for example, but walk us through where you see the biggest growth.
They do have government contracts with NASA, but that's because they're really good at what they do in terms of underlying business and delivering product at the best possible price to those underlying operations. But I would say the biggest growth and where we get most excited about is on the Starlink side of the business. You have 2.8 billion people in the world that don't have access into internet. So when you're thinking about this company, you need to think about just the Starlink portion as almost the worldwide telco carrier. You can touch pretty much anywhere in the world with that underlying Starlink business. And you're just touching the tip of the iceberg. With 10 million subs right now, that 10 million subs is growing quite quickly. So we're extremely excited about the underlying growth of Starlink.
Remind us why Musk is pursuing an IPO right now. How much of this is about data centers in space?
A big proponent, like you can see a big proportion of it. You can see how much capital is going into the data center space on Earth right now. There's only so much energy that we have. When you go up into space, obviously abundant energy. You're sitting there with solar panels on these underlying data center factories within the sky. So a cheap cost of power. Additionally, on the cooling side, extremely cold up there, so we don't need to run liquid cooling technology down here on like we have to do on Earth. So I think there's a lot of capex that's going to be needed to be able to put those underlying data centers into space.
Okay, we know there are new rules that cut down dramatically how long it takes to get listed on the NASDAQ. How long has it been cut down to? What was it before?
Yeah, conventionally it used to be after 180 days, a stock would be picked up into the underlying index. Think of the S&P 500, think of the NASDAQ 100. If you can get your stock into those indexes, that can really propel the growth and the value of your underlying share price. So before that 180 days, that was the old world. Now, because SpaceX is so large and because these companies are staying private longer and longer and longer, they're allowing this change where after the first 15 days of trading, they will allow these companies into the index. So that's a big change, and SpaceX getting that option. That's going to make the IPO, in my opinion, an extreme success because there's so little stock to be able to be traded. I know people are saying $75 billion that he raises. Well, you have to think about the amount of passive capital out there in the market that's going to be buying just that $75 billion that's going to be tradable.
Okay, what prompted this move to cut down the time? Was that specifically catering to the SpaceX IPO?
I think a lot of those indexes and exchanges want to win the business and want to have that company in the index. And you also have to think about, like, this is a $1.75 trillion potential IPO. That's a big business. And for passive individual investors not to be able to have access into it because they have to wait the 180 days before it gets picked up into the index, I think it's a great move. And I think it's a great move for companies that we invest in, where our whole thesis is companies are staying private longer and longer and longer. And because this is happening, when they go out there, they're going to need that demand coming from the indexes because they are such large businesses.
Do you think then, based on what you're saying, it'll attract more IPOs? You mentioned a lot of private companies have been staying private longer. Do you think that'll change the dynamic?
I think this is a really good dynamic for people to realize that, wow, we can get picked up with that much buying demand very quickly as opposed to waiting that 180 days. I think it'll attract some other big names from OpenAI to Anthropic to Stripe. Those companies are sitting there looking at this SpaceX IPO and being like, wow, that's a lot of buying demand that's going to come into the market for a large company.
Stats Canada has released the latest trade data. In February, Canada's merchandise trade activity increased sharply, with imports rising 8.4%, exports by 6.4%. As a result, Canada's merchandise trade deficit with the world widened from $4.2 billion in January to $5.7 billion in February, the largest shortfall since August, as imports reached a record high on increased gold imports. Still ahead, today's market drivers with Bloomberg's Stevia Balgi, and our phone lines are open. Patrick Horn, principal at Agilith Capital, is taking your questions. Call us at 1-855-326-6266. Email us firstcall@bellmedia.ca. For a look now at some early market movers, we are joined by Bloomberg's Stevia Balgi, managing editor for breaking news in the Americas. Divya, thanks as always for joining us. Unilever, boy, oh boy, people not happy with them.
Yeah, I mean, if you look at their shares, I think they've dropped more than 20% since a peak in February. They just announced a deal with McCormick where they are going to combine Unilever's food division with McCormick in and of itself. On Tuesday, when they did announce it, their shares did have a big drop as well, indicating that investors may not be too excited about this deal. I think there are a couple of things here. First of all, you see Unilever as a defensive bellwether. Perhaps moving that food business out of it actually takes away a little bit of that bellwether category that it is under. Now, another part of this is the fact that a lot of investors are not exactly excited about the food division being combined with a highly leveraged U.S. company, which is McCormick as well. And lastly, when you think about these types of spin-offs that happen, a lot of it has to do with value creation, right? Like, what are investors going to get from this? And there is a lot of concern around that. The fact that it will take quite a bit of time for the deal to close, the fact that we really don't know how this value creation is actually going to show up for investors. One of the analysts had said this is going to take a little bit of time to cook, is the word that they used, in terms of this deal going through and being able to see that value creation. Another analyst said this is going to take about 15 months, which is a long time for investors to wait.
Mm-hmm. Do you think we could see this fall through?
I don't think the deal will fall through per se. I think it took them a while to get there. I think the question is how many investors are willing to wait this out. You know, are they going to sell out of Unilever because now that food division is gone? Are they going to sell out of McCormick as well? You know, I think those are the things that, you know, investors might be paying more attention to.
Okay, and Vail upgraded to Bank of America.
Yeah, I mean, this is an interesting one. You know, far be it to see a mining company get upgraded at this point. There's a lot of concern with mining companies around diesel and fuel costs, rising costs, geopolitical tensions. Now, what this analyst is saying after upgrading the stock or the ADRs to a buy equivalent rating is just the fact that its copper production will likely offset fuel and diesel cost pressure that the rest of the companies or the rest of the industry is facing. That and the fact that, you know, iron ore at about $103 per ton is equivalent up to about 10% of its free cash flow. Again, that's a pretty good number to be seeing currently. They've raised their share price target by about $1. The shares are still down for the day, just a little bit in pre-market trading, but still, you know, very good news for, or at least, you know, a very upbeat report from an analyst talking about how this is one of those companies that could potentially stand out during this geopolitical tensions that we have right now.
All right, we'll wrap it up there. Divya, thanks as always for joining us. Have a great long weekend.
Thank you, you too.
Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including TELUS is what we're going to be looking at when we come back. Let's take a look at some of the notable analyst calls and recommendations. TD Cowen analyst Vince Valentini cutting the recommendation on Canadian telecommunications stocks, Rogers Communications, BC, our parent company, and TELUS to hold from buy, writing that recent strength has been due to investors seeking a safe haven during the war in Iran. In a note to clients, Valentini wrote, quote, "The data on key volume, population, and price drivers has been weak throughout the first quarter of 2026, but telco stocks have likely been supported by dividend yields and investors seeking safety from geopolitical uncertainties." BMO analyst Tim Casey struck a similarly cautious tone in a Wednesday note, cutting Q1 growth estimates for the three companies based on elevated competitive intensity in a low loading period. For more on the telcos, let's bring in Patrick Horan, principal at Agilith Capital, and I saw a lot of head nodding over there. I think you were agreeing with most of what was said.
I think they're all good points. Just from a historical nature, we were short telcos like a year and a half ago, and on a dividend cut theory, especially with BCE, we're still short Rogers right now. We think they have too much debt from the Shaw acquisition. Freedom coming into the market, or Quebecor in the wireless market, has definitely changed the game in terms of the margins that they're getting, and the four-player environment makes it that and wireless at least makes it so that it's going to be very competitive for a while. So they're not going to get their free cash flows out. Lots of capex has been sunk in, and their former dividends were based on very lofty expectations of what they could do in terms of wireless. Now, having said that, we're now here today. The more interesting one that we're looking at from a buy standpoint, for the first time, we haven't bought a telco in like 5 years or 6 years, is TELUS. We think there's a change component there. We wouldn't buy it ahead of the dividend cut, but we think there's enough other stuff that they can use as levers to counterbalance their debt load, that they could come out, especially on a much leaner system and a much different way of running a telco, which new management will probably head towards. That there could be something very interesting in this stock. We're still short we're still short Rogers. We do see we echo what Vince and Mr. Casey have written about in terms of the pain points, the short-term pain points, immigration and wireless competitiveness. So we see that for sure.
And going back to TELUS, what are some of the things that you mentioned? Management, what else?
Management. Well, Victor Dados, who was formerly at CIBC, has come in as the new CEO of TELUS. So there's going to be a rethinking there at TELUS. We're trying to figure out what he's going to do, but I think it's going to be something very different than what, and we like that. We like that component of change is typically very good, reinvigorates profits. They see a path forward. There's probably going to be some layoffs they're going to result in that. They're going to have to rethink who they are to Canada and communications. But we think that's a far better strategy than, say, going into the States like what Bell has done.
All right.
From a growth standpoint.
All right, we'll wrap it up there, but lots more to talk about coming up. But first, NASA's crew of astronauts launched to space and reached a stable orbit, kicking off a landmark journey that will take them closer to the lunar surface than anyone has been in more than 50 years. Bloomberg's Ed Ludlow reports from the Kennedy Space Center in Florida.
4, 3, 2, 1, booster ignition.
That was the moment that NASA sent astronauts back toward the moon for the first time in more than 50 years. Artemis 2 is a dress rehearsal, first for NASA's Space Launch System, or SLS, developed by Boeing, which generated almost 9 million pounds of thrust when it lifted off from Kennedy Space Center, Launch Complex 39B, here in Florida. Initially, there's this 2-day orbit of the Earth at different altitudes, practicing burns, practicing manual control of the Orion spacecraft before a translunar injection. That then puts the crew on a slingshot around the far side of the moon. 250,000 miles of distance, a total round trip of 685,000 miles, at one point 4,000 miles from the moon's surface. And in that time, the crew on board are going to be practicing maneuvers, manual control of the spacecraft, communication systems, emergency procedures, because Artemis 2 is just one step in a bigger picture plan to return astronauts to the moon's surface, potentially as soon as 2028. That is America and NASA's goal. And it's been an expensive enterprise, $4 billion per launch, a $93 billion program cost. And it's a race against China, who have their own ambitions to land on the moon. They've stated 2030. The crew of Artemis 2 are expected to splash down on the west coast of the United States in 10 days' time. This is Ed Ludlow for Bloomberg News at Kennedy Space Center in Florida.
And it was beautiful to watch. When we come back, Patrick Horan, principal at Agilith Capital, takes your questions on First Call. Time for First Call, and we have our first email. It's from Peter, and he says, I'm interested in your thoughts on Russell Metals in particular and steel going forward for Canada.
Yep.
That's a crystal ball one. Although Trump today was saying that we heard that he's going to give some more clarity on some of the tariffs for steel and aluminum.
Oh, is that right?
Yeah.
Yeah. I didn't see that, but yeah, we like Russell.
Trump clarity, so we'll see what that means.
Yeah, exactly. Yeah. It's we're going to end it, but not quite in the future.
Yeah,
whatever that means. So Russell, we own Russell. I think we've held it easily since 2020. It has been a very good performer for us. We continue to have a very significant overweight in it. We like management. We think we follow this company for the past 20 years. Mm-hmm. This is a very, very sharp management team, and probably one of the best Russell management teams. They know their business. They're free cash flow converters. They're really not that exposed to steel in themselves because they basically take it wholesale, sell it retail, if you will, and with some value add stuff on top of it. So they're constantly taking from the rack rate and selling it into the market. So they just turn over their inventory, and that's how they make their money. So they're somewhat insulated from fluctuations in steel. They have no exposure to tariffs per se because they're so locally based. They do an excellent job at producing that free cash flow, either buying back their shares and actually buying contiguous operations, usually family run. They get it a deal, they bring it in, integrate it, put best practices behind it, and build up their return on equity from that investment. So, good dividend. This is like one of those companies you just put.
Can we pull up a 5-year chart for it? Just I'm curious because you had it about 5 years.
Yeah.
So,
we bought it around $16.
I mean, is it a moat essentially?
It's a moat. Yeah. They just know their business really, really well. I think if you go back to 2020, you'll see it was down to 16. It was almost like if you can buy this thing at book value, just buy it and don't even think of it. There you go, 2020. It was a perfect. I think we bought it at 1.1 times book. It's probably trading at 1.4 times book right now, but still a very good company. Just fantastic. Just put it away. Don't even think about it. It's a great dividend stock. It's a great grower. Anyway, can't say enough about those guys.
Okay, let's get to another email. This one from Jimmy. I'm interested in the share buyback program at TELUS. Patrick, is your view of this activity a reset toward a growth plan?
Yeah. So they've, TELUS. The problem with TELUS is they've had a high dividend, ultra high dividend that they've defended. They've had an ATM program, so they've actually been leaking shares into the market. MTM program, sorry, and they have all of these kind of assets that are not telco related, health and data center stuff, mm-hmm. And they're going to have to refocus this company in a very large way. We're looking at it as a possible buying opportunity. I think I was here last time, and I think I mentioned that.
You also mentioned it last time, last break before the break there.
Yeah, and we're watching very closely. We quite like new management. We think new management definitely can be a very big driving force for change and for value creation. So that's why we're watching it here. We'd like to see a dividend cut. 50% kind of as a minimum, and it would allow them to reinvest some free cash flow as a result of that. But this is the most interesting stock that there's probably 10 on our radar screen. This is one of them right now. A year ago, I never thought I'd be looking at telcos because I thought they were dead in the water. But this one,
it's a difficult sector right now, isn't it?
It has been. It's been terrible. It's been like dividend cuts all over the place and disappointments and new competitive areas that are coming in. But this has a potential change component to it. So we see it as different.
Okay, let's get another email in. This one from Anna. Could I get your guest's thoughts on WSP Global?
Yeah, so this has been a darling of a stock up until about the past year when people thought AI was going to have a really big impact on the engineering community. And we think there is going to be some impact. We think it's a that management is probably positioned to utilize AI and actually propel their business model forward. So we see this. We see AI. See, there you go. It really fell off a wagon here. But it was a bit of a darling. Typically, you want to flush out the overenthusiasm, maybe another couple months, and then relook at it as a buying opportunity or to add to it. But we think it's a good stock. We think they've got a good business model. When you have these infrastructure projects, you have to look to engineering firms to figure it out. Governments aren't going to do it for them. So any company that wants to put any kind of hard asset on the ground has to employ these guys. Hospitals, buildings, whatever, transportation. They need companies like this. So there is a place for this. AI, we think, is an enhancer to what they do, an accelerator, and we think the management team will probably gravitate.
Does it feel like this is the year, like everybody's saying, this year we implement AI, but it's also the year that we realize maybe AI is not going to destroy a lot of companies because they're already in the game and now they're bringing in a new tool.
Yeah, and I think everyone's looking at this going, oh my God, look at this. We can do all kinds of stuff with it. So there's a lot of possibilities to get right, a lot of possibilities to get wrong. Having said that, the ones that are ignoring it, saying, "Oh, we just need to be this. This is who we are. This is who our roots are." Those are the guys in trouble.
Okay, we got to wrap it up there. Thanks as always for joining us, Patrick Horn, principal at Agilith Capital. The Open is next. Trading gets underway in just over 30 minutes. Have a very long weekend.